In a bull market, there is only 3 positions that you can possibly have. Really long, long, and neutral. That's hard for most people to understand. There's only 3 positions you can have in a bull market. Really long, long, and neutral. I can't tell you how many people I've seen, and I've done it. I'm a human being. I screw up. But how many people do you know? Here, gold is going up. It just made to $1,000 an ounce. Smart guys called me the other day and said, what do you think? Should I get out of my gold and maybe go short a little bit? Might work. Might work. Could work. Hope it works for you. You're an idiot if you try it. Why? It's a bull market. You should either be really bullish, kind of bullish, or neutral. Don't sell bull markets short. In a bear market, you'll never guess what 3 trades you should have on. Anybody want to guess? Really short, short, and neutral. You're learning. In a bear market, you should only be really short, short, or neutral. When you understand that, it will be like coming out of the darkness into the light. Because you'll stop doing stupid things. You'll stop trying to get both sides of the market. Remember, there are trading gods up there. And they watch us. And they look. And when you try to get cocky enough to think that you can be a buyer of something that's going up and then get short of it and try to catch the other way, the gods have to look down at you and say, we're going to have to smack the crap out of you. We're just going to have to do that. And you know what they're going to do? They're going to make the bull market continue to go up right in your face. And now not only are you losing money, but you're not making the money you should have been making. Oh, and now you're going to hemorrhage real mental capital. So stop that. In a bull market, there's wisdom there. There really is wisdom there. 95% of you won't get it. But there's wisdom there. In a bull market, you can only be really long, long, or neutral. In a bear market, you can only be really short, short, or neutral. Another good rule. Lord Keynes was a communist. But he had some interesting things to say. Keynes made all of his money speculating. He was really kind of an interesting speculator. And Keynes had 2 things that I think are just uncommonly brilliant when it comes to trading. He once said, the markets can remain irrational far longer than you or I can remain solvent. There is real brilliance in that statement. Gartman's corollary to that is the market will return to rationality the moment you have been rendered insolvent. Okay? That's the harsh reality. But Keynes was right. The market can remain irrational. Now, the Chicago School of Economics, the Harvard Business School, Yale's Business School, Duke's Business School, the University of North Carolina's Business School, God help them, the hated Tar Heels, would tell you that the markets are, that they are rational, that they are properly priced. That's crap. Write that down. Keynes was right. The market can remain irrational far longer than you or I can remain solvent. Really, really good case in point. The bull market in dot-coms from 1999 to 2001. Let's be honest, the last year and a half of that was utter and complete irrationality. Prices went way too far. Really smart guys I knew kept trying to sell it short in 1999. They tried to sell it short in 2000. Heck, I tried to sell it short once or twice in 2000. I have to learn the lessons all the time. I had to have it proven to me once again that the market can remain irrational, and it went farther than any of us ever dreamt. On the downside, once it started to go down, there was plenty of time to get short, and when it started to go down, it went beyond rationality again on the downside. Keynes' statement, I thought, was brilliant. Keynes also has a statement that's not in my rules of trading, but I thought it was a really keen statement on his part. Keynes used to give a lecture every year. at his school and at his university in England. And he would always talk about one stock. And he would explain fundamentally and technically why you should buy this stock. And one year he was talking about some stock. It's not important what it was. He was telling everybody to buy it. The next year, he came back, and he's telling everybody in the audience that same stock that he was buying last year, he's now selling it. Not only is he selling it, he's selling it short. And somebody in the audience said, Lord Keynes, how can you do that? Last year you were telling us every reason why you're buying this stock, and now you're telling us to sell it short? How is this possible? And Keynes made a brilliant statement when he said, Sir, the facts have changed. And when the facts change, I change. And then he made a really brilliant statement, and he said, when the facts change, I change. What do you do, sir? Most of us don't understand that when the facts change, most of us don't change. What was Keynes saying? The price was changing. It was no longer going up. The most important fact of all trading is price. That's the most important fact of them all. And Keynes was telling us the price had changed. It wasn't going up anymore. When the facts change, I change. I had the great good fortune of working many, many years ago with the most brilliant woman, I think, in the world of economics today. We'll call her Judy. None of you have ever heard of Judy. None of you will ever hear of Judy. Judy knew more, knows more, and in 5 more years will continue to know more than anybody else about economics that I've run across. She understands the waxing and waning of economic activity. She understands Federal Reserve policy. She understands unemployment. She's just bloody brilliant. And it was shocking how much money Judy was capable of losing for the bank that I worked for. It was truly mind-numbing. To the point where senior management would have to come and tap her on the shoulder and say, Judy, that's enough now. We can't take any more. Now, here's a guy standing in front of you who said that he gave Nick Leeson his idea. And here's a guy who's telling you that the most brilliant person he'd ever met in the business of trading was Judy, who lost more money for a bank than was capable of understanding. What could Judy have taught me? Judy taught me this. Being early, write this down, sucks. Okay? Write that down. That's important. Because everything that Judy said was going to happen would happen in exactly the way Judy said it was going to happen. It would unfold in exactly the manner Judy said it was going to unfold. And she would always be out of her trade. And it was sad. Rarely did it happen 2 hours after she got taken out. But normally it didn't happen more than 2 days. And at worst it would happen 2 weeks. After she'd have some wonderful, massive 6-month, 8-month, 10-month idea, 12-month idea that she thought was going to come to fruition, and she'd be taken out, and suddenly the market would start moving in her favor, and she'd never put the trade back on. And then she'd sit there, and she'd watch. She'd say the market's going to rally. She'd be stopped out on the lows. The market would start to rally. She'd watch it, sadly, watch it continue to move higher and higher and higher, and finally she'd start to get bearish on the market. And she'd get bearish, and it would go higher and higher and higher, and everything she'd say was going to happen, but they'd take her out of her position, and then it would start to fall and fall and fall. She did this, and she will do this forever. What does this teach you? Understand 3 or 4 or 5 economic fundamentals as to why something should be going up or why something should be going down, and then wait till it's going up or wait till it's going down and then act. Even if you bought the bottom, you won't believe it. Even if you buy the low tick, most of you will get out after the first half-point move. Don't do that. Wait until you can get 2 or 3 or 4 or at most 5 reasonable economic fundamentals that make sense to you, that are bullish, and the market starts to go up, and then buy it. Or wait till you get 3 or 4 or 5 economic fundamentals that make sense to you, that are bearish, and wait till the market starts going down. And then sell it. Buy markets that show the most strength. Sell markets that show the most weakness. This is hard for most of you to do. It's easier to think, I love this metaphor that I use concerning selling things that are going down. Throw rocks into the wettest paper sack. They break easiest. Think about that. Throw rocks into the wettest paper sack. They break the easiest. Something that's already going down will have a greater propensity to continue to go down, especially if it's been going down for 5 or 6 months, and every single person you know is long of it, and they're long of it, and they're not happy, and they're going home at night, and their wife is beating them up, asking them why they're continuing to be long of it, and either that they're going to throw up and panic and get out, or they're going to buy more to prove that their wife is wrong, and what ends up happening, it continues to go down until they finally get to that page. I think it's on page 115 of your Paul Samuelson textbook in Economics 101, the puke point, the level at which you throw up all over your shoes. Okay? We've all been there. Don't do that. Another good rule, we actually just covered it a minute ago, think like a fundamentalist. Trade like a technician.